Most traders don't blow up because they're wrong about direction. They blow up because they're right about direction, at the wrong size. You already know what I'm talking about. You've seen this pattern. Maybe you've lived it. A trader studies the charts, finds perfect setups, even catches the trend early, but they're risking 3%, 5%, 10% per trade. One normal losing streak, the kind that happens to every profitable system, erases months of progress in a week. Here's the brutal truth that separates amateurs from professionals. A trader risking 5% per trade with a 55% win rate can still go to zero. A trader risking 0.5% per trade with the same edge can survive almost anything. Same brain, same strategy, different position size, different life. This is the first real identity divide. Amateurs ask, how much can I make if this works? Professionals ask, how little can I lose when this doesn't? That single question reveals everything about who survives and who disappears. The amateur is already spending unrealized profits before the trade even moves. The professional is calculating the exact exit before entering. One is dreaming, the other is engineering. Let me show you the mathematics that most people refuse to face. Take a trader with a decent system, 55% win rate, solid risk-reward ratios. On paper, they should compound steadily. But they risk 5% per trade because it feels serious, because they want to grow fast, because 2% feels like nothing. 4 consecutive losses, which is completely normal, costs them 20% of their account. To recover from a 20% drawdown, they need a 25% gain. That's not a trading problem. That's a math problem. And math doesn't negotiate. Now put the same system, same trader, same market conditions, with 0.5% risk per trade. 4 losses, costs them 2%. Annoying? Yes. Career ending? Not even close. They need a 2.04% gain to break even. The difference between needing a 25% gain and a 2% gain is the difference between desperation and patience, between revenge trading and disciplined execution. Let me paint you a picture you might recognize. A new trader starts with a $10,000 account. He's done the work. He understands patterns, support, resistance. He catches a hot sector, risks big, and in 3 hot weeks turns that 10,000 into 14,000. 40% gain. He feels brilliant. I've finally cracked the code, he tells himself. The market makes sense now. He starts calculating how much he'll make if he keeps this pace for a year. The math looks incredible. Then, reality hits. The market shifts character, not a crash. Just chop, more noise, less follow through. He takes a trade and loses 5%. Annoying, but he shrugs it off. The next setup looks good, another 5% loss. Now he's irritated. The confidence starts to crack. 3rd loss hits. Another 5%. He tells himself, I just need one good trade to get it back. So what does he do? He sizes up on the 4th trade, tries to force the win. The 4th loss hits. In less than a week, 20% of his account is gone. But here's the real damage. It's not just money lost. It's confidence lost. Identity lost. That feeling of being a winner evaporates. Now he's behind, and behind feels unbearable. His nervous system is hijacked. Every tick feels personal. He starts forcing trades to make it back. He takes setups he would have passed on 2 weeks ago. He moves stops wider because he can't afford another loss. The account may still show 5 figures, but psychologically he's already blown up. Now compare that with a trader risking 0.5% per trade. Same 4 losses. Same bad timing. Same market conditions. He's down 2%. On a $10,000 account, that's $200. It stings. Nobody likes losing. But it doesn't shatter him. He doesn't wake up in a panic. He doesn't feel the urge to triple his size just to feel something. He can look at his journal, look at the charts, and ask a calm question. Is the edge still valid, or is the market changing? In other words, he keeps his mind. Here's the hidden rule most people refuse to accept. You don't blow up from bad trades. You blow up from big trades. A bad trade with small risk is a statistic. A bad trade with oversized risk becomes a trauma. The market seeks out your breaking point. If you're leveraged to the hilt, your breaking point is very close. If you're small, you become unshakable. Think about your worst trading decisions, the ones you're ashamed of, the ones you don't even like to admit to yourself. Were they your smallest positions, or were they the trades where you went too big, too confident, too fast? Almost every trading horror story starts with, "I broke my usual size rule, just this once." When you truly commit to 0.5% risk, something strange happens. It's the second effect that most people miss. It doesn't just protect your capital, it rewires your psychology. When your maximum loss per trade equals what you'd spend on lunch, your nervous system relaxes. You stop flinching at normal pullbacks. You stop staring at every candle. You can let the stop loss do its job without constant intervention. Your whole approach to setups changes. You stop throwing trades at the wall. You become choosier. You start asking, does this setup deserve my 0.5%? That question alone will save you from half your impulse trades. Risk discipline forces trade selection discipline. You gain the ability to wait for your pitch instead of swinging at everything. And that patience, that selectivity, that's what actually creates wealth in this game. Suddenly, the classic advice like cut losses fast and let winners run becomes something you can actually execute, not just nod along to. When you risk 0, 5%, entering a trade should feel like ordering coffee. Routine, unemotional, mechanical. If you feel your heart rate spike when you hit the buy button, your position is too big. Period. This is why 0.5% risk per trade is not some conservative, scared approach. It's a professional standard. It's what allows you to lean into your edge without being emotionally hijacked by every tick. It turns you from a fragile trader who depends on every single outcome into a robust trader who focuses on process across hundreds of outcomes. In this video, we're building a complete protocol around one quiet idea: 0.5% risk per trade. Not as a suggestion, as a professional baseline. Because there's a second strange effect of risking only 0.5%. It doesn't just protect your capital, it changes your psychology. It gives you patience. It gives you discipline. It gives you the ability to survive long enough for probability to work in your favor. And that's where real, stress-free growth begins. Here's the trap that destroys more trading careers than bad entries ever will. You say you want to be a professional trader, but your position sizing screams amateur. Your words say long-term wealth building. Your risk per trade says lottery ticket. When you risk 2 or 3% per trade, you're not planning for longevity. You're planning for a quick win or quick exit. That's gambling psychology dressed up in technical analysis. You might have the cleanest chart patterns, the most disciplined stop losses, the best fundamental research, but if your size is wrong, none of that matters. The professional doesn't think in individual trades. He thinks in campaigns. A military commander doesn't send 10% of his entire army into a minor border skirmish. If he did, he'd have no reserves left for the actual war. A campaign requires an army that can fight tomorrow, next week, next month, regardless of what happens in today's battle. Let me tell you about Mark. Because Mark represents thousands of traders who had everything right except the one thing that mattered most. Mark wasn't some gambler throwing money at meme stocks. He was methodical. He spent 6 months backtesting a solid system, win rate around 55%, decent reward-to-risk ratios, clear entry and exit rules. He understood market structure, knew where to place stops, could read tape action. On paper, Mark should have compounded his money steadily for years. But Mark was reading the classic trading books, and they all said the same thing: risk 1 to 2% per trade. 2% sounded reasonable. It sounded disciplined. Compared to the guy risking 10%, it even looked conservative. So Mark committed to 2% risk per trade, because that's what the professionals supposedly did. 3 months into live trading, Mark hit what every real trader hits sooner or later: a normal drawdown, not a market crash, not a black swan event, not even bad luck, really. Just the natural, statistically predictable clustering of losses that every profitable system experiences. Over 2 weeks, he took 9 trades. 7 of them were losers. Do the math on that. 7 losses at 2% risk each. Even accounting for the 2 small winners mixed in, His account dropped 14% in 10 trading days. 14% doesn't sound like zero, but in the nervous system of a trader, it's a catastrophe. Suddenly, everything changed. Mark wasn't trading to build wealth anymore. He was trading to survive. Every time he saw a setup, he didn't see opportunity. He saw a threat. His brain started asking the wrong questions. Instead of, is this a high probability setup? He was asking, what if I lose again? Instead of following his tested rules, he was calculating how many more losses he could afford. The pressure became invisible, but crushing. To recover from a 14% drawdown, Mark needed a 16% gain just to get back to break even. That mathematical reality set in the back of his mind like a weight. He started second-guessing signals that met all his criteria. He'd see a perfect entry, hesitate for just a moment, and watch it run without him. Then, out of frustration and desperation, he'd chase a marginal setup just to feel like he was doing something. That one would stop out immediately. He began skipping trades because he couldn't handle another loss. Then he'd revenge trade to get back to even, taking setups that barely qualified. He started widening stops because he couldn't afford to be wrong again. The system didn't fail Mark. The math didn't fail. His psychology cracked under the weight of that 14% hole. And once psychology breaks, edge becomes irrelevant. Now I want you to replay that exact same scenario. But imagine Mark had adopted what I call the professional standard. 0. 5% risk per trade. Same trader, same brain, same system, same market conditions, same 9 trades, same 7 losses. The market treats him exactly the same way. But look at the account damage. 7 losses at 0.5% risk equals a 3.5% drawdown. Even with commissions and slippage, he's down maybe 4% total. Is he annoyed? Absolutely. Nobody smiles at a red equity curve, but is he psychologically broken? Not even close. A 4% drawdown isn't a crisis. It's a cost of doing business. It's a scratch on the paint, not a hole in the engine. To recover from 3.5% down, Mark needs a 3.6% gain. That's not a mountain to climb. That's a normal trading week. The Mark who risked 3.5% can still think clearly. He can sleep at night. He can look at the charts the next morning without his heart racing. He doesn't need to hit a home run to get back to even. He just needs to keep executing his tested process. Most importantly, he has preserved his mental capital, which is infinitely more valuable than his financial capital. This is what 0.5% risk really buys you. Emotional room to breathe. When your maximum loss per trade equals what you casually spend on lunch, your brain stays calm. Calm enough to follow the original plan. Calm enough to let the tape confirm or deny the trend instead of forcing it. Calm enough to cut losses fast without hoping, without praying, without moving your stop just one more time. And calm enough to let winners run without grabbing at early profits out of terror. Think about the 2 hardest things to do in trading. First, cutting a loss instantly when the trade goes wrong. Second, letting a winner run when the trade goes right. Everyone knows they should do this. Almost no one actually does it. Why? Because the fear is too loud. You don't cut the loss because it's big enough to hurt. You hope it comes back. You bargain with the market. You turn a trade into an investment. And you don't let the winner run because you're so terrified of giving back your profits that you snatch the money off the table the moment it appears. You bank a 1-to-1 winner when the market was ready to give you 5-to-1. But when the risk is 0.5%, the fear evaporates. If the trade goes against you, cutting it becomes mechanical. Click. Done. It cost you virtually nothing, so there's no emotional pain to avoid. And if the trade goes in your favor, you can sit on your hands. You can let it breathe. You can withstand the normal pullbacks that shake out everyone else. Why? Because even if it comes all the way back to your entry, you haven't lost anything meaningful. This reveals the central paradox of professional trading. Smaller risk gives you bigger patience. Amateurs think that to make big money, they must risk big money. The opposite is true. To make big money, you must capture the big moves. To capture the big moves, you must stay in trades through the noise and volatility. To stay in trades through noise, you must be emotionally indifferent to the fluctuations in your account balance. The only way to achieve that indifference is to size down until the money becomes boring. When you treat each trade's risk as negligible, you stop staring at your profit and loss column and start studying the chart. You start managing trades based on what the market is actually doing, not on what your mortgage payment requires. That's how you catch those 3-to-1, 5-to-1, even 10-to-1 winners that actually build wealth. You catch them because you weren't scared enough to exit early. Your risk percentage isn't just a number. It's a mirror. It shows you who you really are in the market. Are you building a career or chasing a feeling? Are you running systematic campaigns or placing emotional bets? The amateur needs excitement from every position. The professional needs consistency across hundreds of positions. When you risk 0.5%, trading becomes mechanical rather than emotional. You follow your rules because breaking them requires conscious effort, and there's no adrenaline demanding you do something, anything, just to feel alive. Mark's account blew up not because he couldn't read a chart, but because he couldn't read himself. He tried to sprint a marathon. He tried to be a hero on every trade, and the market punished him for that arrogance. The 0.5% rule is an admission of humility. It says, I might be wrong on this trade, and that's perfectly acceptable. It removes ego from the equation. When you remove ego, you remove stress. When you remove stress, you finally have a chance to see the market as it actually is. But here's where most traders make their second critical mistake. Even when they accept the philosophy of smaller risk, they treat position sizing like a feeling rather than a formula. They look at a chart and say, I'll buy 500 shares, without realizing that 500 shares on this stock might be a death sentence, while on that stock it's a waste of time. They think position sizing is about intuition or experience. Professionals know it's pure mathematics, and there's an exact formula that dictates precisely how large you're allowed to be on every single trade. The second mistake that quietly destroys more accounts than bad chart reading ever will is this. Traders think position sizing is about feel. It's about intuition. It's about how confident they are in the setup. Professionals know position sizing is pure mathematics. Your emotions have no vote in this decision. Your excitement about the trade has no vote. Your fear has no vote. There's a formula that tells you exactly how big you're allowed to be, and that formula is your defense against yourself. When you size by feel, you do exactly what amateurs do in every field. You get big when you're excited. You size up when a trade looks perfect. You go light when you feel uncertain. In other words, your position size tracks your emotions, not your edge. That is the exact opposite of professional behavior. Professionals standardize risk first, then let the market decide the outcome. Here is the complete new 0.5% protocol. 3 steps. No exceptions. No creativity. No personal interpretation. Step 1. Decide your account risk per trade. This number is fixed, non-negotiable, and always 0.5% of your current account equity, not what you started with months ago, what you have right now. If your account is $20,000, 0.5% is $100. If your account is $50,000, 0.5% is $250. If your account is $5,000, 0.5% is $25. These numbers might seem small. They're supposed to. They're not designed to impress anyone. They're designed to protect you from the one person who can destroy your account faster than any market crash: yourself. Step 2. Define your stop loss based on chart structure, not your feelings. This is where most traders quietly corrupt the entire process. They see a beautiful setup and think, if I put my stop here, I can take 100 shares. But if I move it just a little tighter, I can take 200. That little tighter is almost always arbitrary. It's not based on swing lows, support levels, or volatility. It's based on greed for more size. Professionals reverse this completely. They let the market tell them where the trade thesis is invalidated. That might be below a clear pivot low, below a key moving average, or outside the normal volatility range. Once that invalidation level is identified, the stop is locked. They don't move it closer to get more shares. They don't negotiate with the chart. They respect what the market is showing them. Step 3. Calculate position size using this exact formula. Position size equals 0.5% of your account divided by your risk per share. Your risk per share is simply entry price minus stop-loss price. No rounding by gut feel. No, that looks about right. Just mathematics. Let's walk through a complete example so there's zero confusion about execution. Your account size is $20,000. Your risk per trade, at 0.5%, is exactly $100. You spot a long setup in a stock trading at $50 per share. You analyze the chart structure and determine that the logical stop-loss, based on the previous swing low and recent volatility, should be at $48. This gives you a risk per share of 50 minus 48, which equals $2 per share. Now you apply the formula. $100 of account risk divided by $2 of risk per share equals exactly 50 shares. That is your position size. Not 60 shares because you feel good about this one. Not 100 shares because you really like the setup. 50 shares, period. With this position, if the stock hits your stop at $48, your maximum loss is 50 shares times $2 per share, which equals exactly $100, or 0.5% of your account. Nothing else can happen if you follow the plan. No hoping it comes back. No moving stops lower because the candle looks like it might bounce. No staring at the screen willing the market to obey you. Once price touches 48, the trade is finished by design. Notice the professional discipline embedded in this process. You do not tighten the stop, just to get bigger size. This is one of the most common amateur errors. They think they're being disciplined by using tight stops, but they've actually chosen stops that are unrealistically close, inside the normal noise of price action, just so they can feel like big traders with big positions. The market punishes this every time. Normal volatility hits the stop, shakes them out, then the trade moves exactly as predicted without them. You also do not widen the stop, because this one feels special. The moment you tell yourself a trade is different, you're already in psychological danger. The chart either supports a wider stop based on actual structure, or it doesn't. If it does, your per share risk increases, so your position size must decrease proportionally. The mathematics don't bend because you're excited. This brings us to the key maxim that separates professionals from everyone else. The chart chooses the stop. You choose how small the loss will feel. The chart's job is to show you where the trade thesis breaks down. Your job is to decide, within your 0.5% limit, how much size that structure allows. Nothing more, nothing less. Let's examine two traders who see the exact same setup to understand why this protocol is not optional. Both traders have $20,000 accounts. Both see the same stock at $50. Both identify the same logical stop at $48. Trader A operates on feel and confidence. He looks at the setup and thinks, this is going to $75. I need to be big. He doesn't calculate anything. He just buys 400 shares because it feels right. He has just risked $800, or 4% of his account, on one trade. The stock immediately reverses and stops him out at 48. He loses $800 in minutes. Now he's down 4%, and his psychology is compromised. He's angry at the market, angry at himself, and desperate to make back what he lost. He starts scanning for another trade immediately. He forces a marginal setup 30 minutes later. That one fails too. By day's end, he's revenge traded himself into a 6% hole. The original analysis was fine. His position size destroyed him. Trader B sees the identical chart and runs the protocol. Account, $20,000. Risk, $100. Entry, $50. Stop, $48. Risk per share, $2. Position size, exactly 50 shares. The stock reverses and stops him out. He loses $100. Is he happy about losing? Of course not. But he's not psychologically damaged. He closes the platform, logs the trade in his journal, notes that the breakout failed on weak volume, and moves on with his day. His account is down 0.5%. Mentally, he's completely intact. 3 days later, the same stock sets up again with better volume and cleaner structure. Trader B is mentally fresh enough to recognize the opportunity and take it. This time it works, and he captures a significant move. Meanwhile, Trader A is still emotionally anchored to that first loss. He sees the second setup but hesitates. What if it fails again? He either skips it entirely or waits too long and chases it at the top. Same chart, same opportunity, different protocols, different futures. This is why the formula isn't a suggestion. It's your shield against the emotional hijacking that destroys accounts. When you remove the market's ability to hurt you meaningfully on any single trade, you remove fear from the equation. When you remove fear, you can finally trade what you see on the chart rather than what you feel in your chest. But here's where traders who accept the 0.5% philosophy often get stuck. They think, if I'm only risking 0.5% and my positions are this small, how do I ever make real money? How do I grow an account trading like a turtle? That's exactly the wrong question, and it reveals they're still thinking like amateurs. Professionals don't make money by betting big on first entries. They make money by starting small with proof of concept positions, then scaling aggressively once the market confirms their thesis. They turn that tiny 0.5% initial risk into massive account gains through a specific technique that most traders execute backwards. It's called pyramiding, and when done correctly, it allows you to build positions larger than you ever imagined, without ever stepping outside your risk comfort zone. The small initial risk isn't a limitation. It's the foundation that makes everything else possible. Risking only 0.5% per trade doesn't mean you think small. It means you start small and grow with proof. This creates a fundamental misconception among amateur traders who hear 0.5% and immediately think they're destined for mediocre returns, nibbling around the edges while others feast on the big moves. That perspective reveals everything about why they fail. The 0.5% isn't a limitation. It's your admission price to the only game that actually builds lasting wealth. It's your entry ticket to scale into massive moves without ever risking your psychological stability. Here's what separates professionals from everyone else in position building. Amateurs pyramid backward. They add to losers because the price is cheaper now. You've witnessed this tragedy countless times. A trader buys a stock at $100. It drops to 94. His brain tells him, if I liked it at 100, I must love it at 94. It's on sale. So he doubles down. He calls it averaging down, lowering his cost basis, being contrarian like the great investors. But trading is not investing, and averaging down in a directional trade is financial suicide dressed up as patience. Every share he adds increases his total exposure at the exact moment the market is proving him wrong. He's financing failure with capital that should be protected. Professionals pyramid forward. They add to winners, into strength, after the market confirms their thesis. This sounds backwards to most people, because every instinct screams buy low, sell high. But professionals understand that price is information. When price rises after your entry, it's not expensive. It's confirmation. The market is literally telling you that your analysis was correct. You're not chasing. You're scaling into proven strength using the market's own money to fund your aggression. This is exactly how Jesse Livermore built his legendary fortune. He never bet the farm on first entries. He used what he called probe trades, small reconnaissance missions sent out to test whether his read of the market was accurate. If the probe came back profitable, if volume expanded, if the tape confirmed his thesis, only then would he deploy the heavy artillery. He let the market tell him when to get big, not his emotions or his ego. Here's the complete structure of professional pyramiding. First, your initial probe at 0.5% risk. This is your test. You're not trying to capture the entire move with this first position. You're asking the market one simple question. Am I right about direction? Second, you add only when the trade moves favorably and confirms your thesis, not because you hope it will work, because it already is working. Third, each add-on has its own stop-loss, often at a higher level than the original, which means each new layer has less risk than the one before it. Fourth, your total account risk stays controlled while your open profits fund the new size. You're playing with the market's money, not your own capital. Think of pyramiding as climbing a staircase. Most traders try to leap from the ground floor to the roof in one jump. They go all in on the first entry, hoping for the best. Professionals climb one solid step at a time. If the staircase breaks, They only fall down one step, not the entire height. Each step is built on the foundation of the previous one. Let me walk you through the complete mathematics so you can see exactly how this transforms a boring 0.5% initial risk into a position that could generate 5, 8, even 10% account gains without ever feeling over-leveraged. Your account is $40,000. Your risk per trade at 0.5% is $200. You identify a stock breaking out of a multi-month base at $100 per share. The chart structure, based on recent swing lows and normal volatility, suggests a logical stop at $96. That gives you $4 of risk per share. You run the formula. $200 divided by $4 per share equals exactly 50 shares. You enter long at $100 with 50 shares and a stop at 96. Your maximum initial loss is exactly $200, or 0.5% of your account. Now comes the critical part that separates professionals from amateurs. You wait. You don't stare at the screen willing it higher. You don't move your stop tighter to lock in a few cents. You let the market work. Over the next few days, the trade begins to confirm your thesis. Volume expands on the breakout. The stock moves cleanly to $107 and consolidates constructively on lighter volume. Sellers try to push it back down, but fail at successively higher levels. This isn't hope talking. This is evidence. The tape is confirming that your original analysis was correct. At this point, the amateur does one of two destructive things. Either he takes profits immediately because he's terrified of giving back his gains, or he does nothing and watches the move continue without increasing his exposure. He's paralyzed by the fear of being wrong or the fear of missing out. The professional sees confirmation and prepares to scale. You add a second position at $107. You set a new stop for this add-on at $103, just below the new consolidation level. That's $4 of risk per share again. To maintain your 0.5% risk standard, you risk another $200. 200 divided by 4 equals 50 more shares. You now own 100 shares total. But here's what makes this mathematically beautiful and psychologically powerful. Your unrealized profit from the first 50 shares is $7 per share. 50 shares times $7 equals $350 of open profit. That profit alone more than covers the $200 risk on your second position. You've doubled your position size, but your actual out-of-pocket risk, your exposure of principal capital, remains tiny. You're essentially playing with the market's money at this point, not your own. If the stock continues to work and consolidates again at, say, $115, you can add a third layer. Same process. Another 0.5% risk. Another 50 shares with a stop at 111. Now you own 150 shares total, and your first position alone is showing an unrealized profit of $15 per share. That's $750 of profit on just the initial 50 shares, far exceeding all the risk you've layered into the position. This reveals the power of the maxim that every professional lives by. Start like a coward. Grow like a lion. Your initial entry is cautious, humble, and small. You're not predicting the future. You're testing a hypothesis with capital you can afford to lose without emotional damage. But once the market validates your idea, once you have that cushion of open profit, you become aggressive in the right way. You're not aggressive with hope or desperation. You're aggressive with confirmation and evidence. There's a massive psychological difference between those two states. At any point in this process, if the tape weakens, if volume dries up, if the price action starts looking sick, your trailing stops do the work for you. Let's say after your third ad, the stock reverses hard and breaks down. Your stops get hit sequentially as price falls. You exit the third position at 111 for a small gain. You exit the second at 103 for a small loss. You exit the first at 104 for a decent profit. Even in this failed pyramid scenario, you're walking away with a net gain because your winners were funding your risk the entire time. Compare this to the trader, who went all in at $100 with his entire risk budget. If the stock reverses, he has one exit, one outcome, and likely a significant loss that damages his psychology for weeks. The pyramiding trader has multiple exits, layered risk management, and protected profits. His losses stay small. His winners have room to become campaigns that can define an entire year. This is precisely how professionals turn a 0.5% per trade approach into 5, 8, even 10% account swings without ever feeling overleveraged, without sleepless nights, without the constant terror that one reversal will destroy months of progress. They're not gambling on single outcomes. They're building positions in rhythm with market confirmation. But here's what makes this approach so psychologically difficult for most traders. It requires you to buy strength. It requires you to add when the price is higher than your initial entry, which feels expensive to every amateur instinct. It requires you to be comfortable with the idea that your average cost is rising with each add. Every fiber in your body wants to buy cheaper, not higher. That's why most traders fail at this, even when they understand the logic. They can accept the 0.5% starting risk intellectually, but they can't pull the trigger on adding to a winner because it feels like they're chasing. Professional traders understand that in trending markets, higher prices after your entry aren't expensive. They're confirmation. The market is literally paying you to get bigger. Your open profits are funding your new risk. This is the opposite of gambling. This is evidence-based position building where each new layer is justified by fresh market validation. The other psychological barrier is that pyramiding requires you to be right about direction consistently enough to build these campaigns. If you're constantly getting chopped out on the initial probe, you never get the chance to scale. This reveals the final piece of the puzzle that makes everything else possible. You can have perfect risk management, perfect position sizing, and perfect pyramiding discipline, but if you're taking every marginal setup that flashes across your screen, none of it matters. You'll death by 1,000 cuts yourself with small losses and never build the winners that justify the entire system. This brings us to the hardest skill for most traders to develop, the skill that separates the final 10% of profitable traders from everyone else. It's not about what you do when you're in a trade, it's about what you do when you're not in a trade. It's the ability to sit on your hands, to watch the market without participating, to treat cash not as dead weight, but as potential energy waiting for the perfect moment to deploy. Because you can only pyramid like this if you are supremely selective about which setups deserve even that initial 0.5% of risk. Here's what separates the final 10% of profitable traders from everyone else. They understand that some days, some weeks, even entire months, cash is the best position on the tape. Not a backup plan, not a failure to act. A deliberate strategic position that preserves capital and mental clarity for when genuine opportunities appear. Most traders understand stops. They understand entries. They study patterns, volume, and momentum with religious dedication, but they refuse to understand waiting. They treat sitting in cash like they're missing out, like every moment not in a trade is money left on the table. This psychological flaw destroys more accounts than bad technical analysis ever will, because it turns a precision tool into a shotgun. Your 0.5% framework only works if you apply it to high-quality setups. Not every wiggle on a chart deserves your capital. Not every bounce off support is a pivotal point. Not every breakout is real. The math of 0.5% risk protects you from catastrophic losses, but it cannot protect you from death by 1,000 paper cuts. If you're bleeding 0.5% every day on mediocre setups, you'll be down 20% in 2 months without ever taking a large loss. The risk management was perfect. The trade selection was garbage. This reveals the hidden truth that most trading education never addresses. Risk management is necessary, but it's not sufficient. You can have flawless mathematics and still fail if you're applying that math to endless marginal setups. The 0.5% rule gives you the freedom to be wrong without catastrophic damage, but it doesn't give you the freedom to be sloppy about what you choose to trade. Let me show you the difference between activity and productivity through two traders who both understand and religiously follow the 0.5% rule. On paper, they're identical. Same risk per trade, same account size, same markets. But their results couldn't be more different, because one understands selectivity and the other confuses motion with progress. Trader A wakes up every morning with one goal: find something to trade. He can't stand being flat. It feels like he's not doing his job. He's a trader, right? Traders trade. So he scans the market and finds setups. Not great setups. Not A+, edge of your seat. This is exactly what I've been waiting for setups. Just setups that kind of look okay. A stock bounced off support. Another broke above a minor level. This one has a decent volume spike. He convinces himself each one is tradable because he needs action, because boredom feels unbearable, because he's using trades to regulate his emotions rather than execute his edge. Over a choppy, range-bound week, Trader A places 20 trades. He follows his 0.5% rule perfectly on every single one. His stops are exactly where they should be. His position sizing is mathematically correct. But the setups themselves are marginal. 12 of them stop out for small losses. 5 break even or scratch. 3 are small winners. By Friday, he's taken 20 trades and he's down 8 to 10%. He sits there exhausted, staring at his screen, wondering what went wrong. The math was right. The risk management was flawless. But the patience was absent. He bled to death from 1,000 paper cuts because he used a professional risk parameter to justify amateur overtrading. Now look at Trader B in the exact same market conditions. He wakes up, opens his platform, scans the same stocks, sees the same price action. But his internal dialogue is completely different. He's not looking for something to trade. He's looking for something that meets his A+ criteria. He treats waiting as a deliberate, active position. He's not inactive. He's actively choosing to preserve capital until the market presents something undeniable. He watches the tape. He marks key levels. He sees the same bounces and breakouts that Trader A took, and he passes on almost all of them. Why? Because they're not clean. The volume isn't confirming. The structure is ambiguous. The risk-reward isn't compelling, even if the setup works. For 3 days, Trader B doesn't click a button once. To an outsider, he looks lazy. To a professional, he looks like a sniper waiting for a clear shot. On Thursday, the market finally aligns. A sector leader sets up perfectly. Volume surges on the breakout. The pivot point is crystal clear. Multiple time frames confirm. He places his first trade of the week. 0.5% risk. It works immediately. He pyramids into the strength using our earlier protocol. He takes 2 other trades that afternoon. One stops out for a small loss. The other trends for days. Over that same choppy week, Trader B places 3 trades total. Just 3. All of them meet his highest standards. 2 small losses, 1 pyramided winner. By Friday, he's up 4%. Same 0.5% per trade. Same market. Different selectivity. Different results. Different career trajectory. Here's the stress test that reveals everything about whether you're truly trading at the right size and with proper selectivity. If you feel your heart rate spike when you hit the buy button, something is wrong. Either your position is too big despite your calculations, or you're taking a trade that doesn't meet your actual standards and your nervous system knows it. Your body is smarter than your rationalizations. When you risk 0.5% on a pristine setup that truly meets your criteria, entering should feel like ordering coffee. Routine. Unemotional. Mechanical. You're not betting your future on this one outcome. You're executing a tested process. This biological feedback loop is crucial to understand. If your hands shake, if your stomach tightens, if you find yourself staring at the position and refreshing the screen every 30 seconds, you've made an error. Your nervous system is telling you that either the risk is too high or the setup is too weak. Listen to it. Adrenaline is the enemy of profitable trading. Boredom should be your friend. The maxim that every professional internalizes is this: discipline is not how you enter. It's how often you refuse to enter. Anyone can click a buy button. The entire retail trading world is filled with people who can pull the trigger. What separates professionals is the ability to not pull the trigger 90% of the time, to watch the market, to see setups that kind of work, and to say no, not because they're scared, because they're selective, because they understand that their edge isn't in being active, it's in being right when they choose to act. So how do you actually train yourself to treat waiting as a position instead of an absence? First, you redefine what constitutes a successful trading day. A successful day is not a day with trades. A successful day is a day where you followed your plan, regardless of whether you clicked the button. If you scanned the market, applied your criteria, and concluded that nothing deserved your risk, that is a perfect trading day. Your edge isn't just your entry pattern. Your edge is your ability to not trade when the market doesn't match your conditions. Second, you schedule your decision windows. Maybe you only allow yourself to take trades during specific times: the open, a mid-session window, and the close. Outside of those windows, you're in observe-only mode. This breaks the habit of constantly hunting for setups and forces you to focus on quality over frequency. Third, you keep a trades I didn't take journal. Every day, capture screenshots of setups you passed on and review how they played out. Over weeks and months, you start to see patterns. You realize how many marginal trades you avoided that would have lost money. You also refine your sense of what truly qualifies as A+. This builds confidence in your selectivity and turns waiting from vague discipline into a measurable skill. The amateur needs constant action to validate their identity as a trader. The professional waits for his pitch. Think about a world-class batter in baseball. He doesn't swing at every ball that crosses the plate. He has a strike zone in his mind, a very specific region of opportunity. Anything outside that zone, no matter how tempting, he lets pass. He knows his career statistics are built on waiting for his zone. Jesse Livermore captured this perfectly when he said, "There's a time to be long, a time to be short, and a time to go fishing." That last part is what amateurs ignore. They think fishing is giving up. Livermore understood that fishing is strategic patience. It's the recognition that the market doesn't owe you an opportunity today, this week, or even this month. Your job is to be ready when it finally arrives, not to force it into existence. Cash isn't empty space in your portfolio. It's potential energy. It's dry powder. It's ammunition waiting for the right target. When you're constantly in trades, constantly churning through marginal setups, you don't have that powder dry. You're always partially deployed in mediocrity, which means when excellence appears, you either have to exit something to fund it, or you miss it entirely. Think about this from a business perspective. You are the house. The setups are the players. A casino doesn't bet on every hand. It sets the rules, ensures the math is in its favor, and waits for the players to come to them. If the player doesn't meet your house rules, they don't get to play. Your 0.5% rule is a precision tool, not a shotgun. It's designed to be applied selectively to high-probability situations, not sprayed across every marginal opportunity. When you combine 0.5% risk per trade with ruthless selectivity, something almost magical happens to your equity curve. It stops looking like a jagged, edgy readout. It starts growing like a professional's curve. Uneven, yes. Some flat periods where nothing happens. Then sharp upward moves when you catch real trends and pyramid into them properly. Then more flat periods. Then another spike. Over time, the trajectory is clearly upward, but it's controlled. It's sustainable. You stop having those catastrophic months that wipe out your year. You stop having sleepless nights wondering if the market will gap against you. You stop the emotional roller coaster that destroys most trading careers before they begin. Most importantly, you start to experience something that most retail traders never feel: calm confidence. Not arrogance about what the market will do next, but confidence in your process. This brings us to the central paradox you must embrace. You have to care deeply about your process, but you must be completely indifferent to the outcome of any single trade. The only way to achieve that indifference is to trade small enough that the loss doesn't hurt, and trade rarely enough that each win matters. When you reach this level, you're no longer gambling. You're operating a business. You're no longer a victim of the market's mood swings. You're a patient predator, waiting for the market to present you with exactly what you need. Waiting creates clarity. When you're not constantly in a trade, you can see the forest for the trees. You can spot sector rotations before they become obvious. You can see distribution patterns forming while everyone else is still buying the dip. You become an observer of the market, not a victim of it. And that observer's perspective is what allows you to finally see the setups that truly deserve your carefully protected capital. Let's close the loop we opened at the very beginning. Remember the brutal truth that started this entire conversation. Most traders don't blow up because they picked bad stocks, misread charts, or lacked intelligence. They blow up because they risked too much on good trades. They were right about direction and still lost everything, because their position size turned a normal market fluctuation into a career-ending catastrophe. Now you understand exactly why that happens, and how to prevent it from ever happening to you. The 0.5% rule isn't a handicap. It's not what scared money does. It's the foundation of a career that lasts decades instead of months. It's the mathematical difference between surviving 20 consecutive losses and being forced to quit after 5. It's the difference between trading with constant fear and trading with absolute clarity. Let's run the final mathematics that prove why this approach isn't conservative, but rather the only approach that makes mathematical sense for long-term survival. Take the nightmare scenario every trader fears. You risk 0.5% per trade and lose 10 times in a row. 10 consecutive failures. That feels catastrophic psychologically, but look at the actual damage. 10 losses at 0.5% each equals a 5% drawdown. To recover from 5% down, you need a 5.26% gain. That's achievable with 2 solid winning trades using standard reward to risk ratios. Now run the same scenario with a trader risking 2% per trade, which most trading books recommend as reasonable and disciplined. 10 consecutive losses at 2% each costs 20% of your account. But here's where the mathematics become vicious. To recover from a 20% drawdown, you don't need a 20% gain. You need exactly a 25% gain just to break even. The calculation is simple if you have 80,000 left from A, 100,000 account you need, 20,000 to get back to, 100,000. But 20,000 divided by 80,000 equals 0.25 or 25%. That's not a trading problem. That's a math problem. And math doesn't negotiate. This asymmetry is what destroys trading careers. A 50% loss requires a 100% gain to recover. Most traders never make it back because the psychological weight of that deficit crushes their ability to think clearly and execute properly. Here's your complete professional protocol, distilled into 4 non-negotiable principles. First, cut losses fast, at 0.5% maximum per trade. No exceptions. No hoping it comes back. No moving stops because the chart looks like it might bounce. When price hits your predetermined stop, the trade is finished by design. This is your mathematical shield against catastrophic loss. Second, size small initially and let the market prove you right before getting aggressive. Your first entry is reconnaissance, not conquest. You're asking the market a simple question. Is my analysis correct? If the answer is no, you pay a small tuition fee and move on. If the answer is yes, you proceed to scaling. Third, pyramid on confirmation by adding to positions only when they're working, and the market is providing fresh evidence that your thesis is correct. Each add-on has its own stop, often at higher levels, funded by open profits from earlier layers. This is how you transform small initial risk into meaningful account gains without ever feeling over-leveraged. Fourth, wait for your pitch and treat cash as an active position, not a penalty for missing opportunities. Most of your edge comes from the trades you don't take. Every time you refuse a mediocre setup, you're preserving capital and mental energy for when genuine opportunity presents itself. When you internalize these principles and execute them with religious discipline, something profound shifts in your trading psychology. You stop trading scared and start trading free. Free from the fear that one trade will destroy your month. Free from the desperation that makes you force marginal setups. Free from the constant monitoring and stress that comes from being over-leveraged. Free to follow your rules because no single trade can meaningfully hurt you. That freedom compounds over time into something amateurs never achieve, consistent growth without constant stress. When you risk 0.5% per trade, trading becomes boring in the best possible way. Entering a position feels routine. Exiting a loser feels mechanical. You're not emotionally hijacked by normal market fluctuations. You can observe your own performance objectively, learn from mistakes without being devastated, and refine your process without the constant interference of fear and greed. This emotional neutrality is the hidden superpower that separates professionals from everyone else. While others are managing their emotions, you're managing your trades. While they're hoping and praying, you're calculating and executing. While they're revenge trading to get back to even, you're patiently waiting for the next high-probability setup. Most traders experience trading as an emotional roller coaster. Euphoria when winning, despair when losing, constant anxiety about what comes next. They check their accounts obsessively. They feel their stomach drop when they see red numbers. That's not trading. That's torture. And it's entirely self-imposed through improper position sizing. Jesse Livermore spent decades in the markets and experienced both spectacular wins and devastating losses. His final lesson, the wisdom he wished he'd learned earlier, was this: the market will give you every opportunity to destroy yourself. It will tempt you with easy money, show you setups that look perfect, create winning streaks that make you feel invincible. Then it will reverse violently and take everything back if you let it. The market doesn't care about your mortgage, your dreams, or your ego. Your job as a trader is not to maximize profit on this trade, this week, or even this month. Your job is to own your process long enough for probability to work in your favor. Edge in trading isn't about being right more often than you're wrong, although that helps. Edge is about surviving your wrong periods with enough capital and psychology intact to capitalize on your right periods. The 0.5% rule ensures that survival. This brings us to the central maxim that encapsulates everything we've covered. The professional doesn't predict the market. He survives it. Amateurs are constantly trying to figure out what the market will do next. They want certainty. They want to be right. Professionals know that certainty doesn't exist. They focus instead on creating a system that survives all market conditions. Bull markets, bear markets, choppy sideways action, flash crashes, euphoric bubbles. Their 0.5% risk framework lets them participate in all of it without being destroyed by any of it. This is the ultimate paradox of trading. To make large amounts of money, you must be willing to risk very small amounts of money. To capture big moves, you must start with tiny positions. To trade aggressively, you must first master defensive position sizing. Everything in trading is counterintuitive, which is why most people fail. They do what feels right instead of what works mathematically. If this lesson has truly landed, if you understand that 0.5% risk per trade isn't a limitation, but a liberation, then you're ready for the next level of skill development. Because risk management is necessary, but not sufficient. You also need to know exactly when to deploy that carefully protected capital. You need the ability to read the tape, to recognize pivotal points where the odds shift dramatically in your favor, to separate real breakouts from fake ones, to see distribution before it becomes obvious to everyone else. That's where the real edge lives. That's the difference between taking 3 trades a week that all work and taking 20 trades that slowly bleed you dry. The 0.5% rule gives you the freedom to develop those advanced skills without the constant terror of blowing up while you learn. It gives you the psychological space to make mistakes, refine your eye, and build pattern recognition across thousands of chart observations. Most traders never develop true market reading ability because they're too busy surviving their oversized positions. They're managing their fear instead of managing their trades. You now have the foundation. Position sizing is pure mathematics, not confidence or feel. Starting small and pyramiding into strength builds meaningful positions without over-leveraging. Waiting is an active position where most of your edge comes from selectivity. The goal isn't to maximize this trade, but to own your process across hundreds of trades. Now go apply it. Calculate your 0.5% risk on your next trade. Let the chart structure define your stop. Let the formula define your size. Enter the trade and experience what it feels like when the outcome cannot hurt you. That feeling is what professional trading actually is. Not excitement, not adrenaline. Just calm, disciplined execution of a process that works, because you'll survive long enough to see it work.